Hi and welcome to this Premier Training revision video which will look at the techniques of process costing, an important part of the costing unit at level 3. Process costing is used in manufacturing where the organisation produces identical units of output in a continuous process. One example we'll use in this video is the mass production of beer in a brewery. In a process like this, it's important to establish the cost of one unit of output. In our example, this could be the cost of a tin or bottle of beer. The easiest way to do this is to divide the total cost of production in the period by the total number of units produced to give us the cost per unit. Another example of a continuous production process is chocolate bars. So, if Chocs Limited incurs total costs of £96,000 in a period and manufacture 1.6 million bars, the cost per unit is £96,000 divided by 1,600,000, which works out at 6 pence per unit. Of course, most production processes include a number of different stages or processes, and it's very rare for any product to be made by just one process. At each stage there may be additional materials and labour, and potentially some losses of material as well. The costs of each stage need to be recorded accurately and passed on to the next stage in the process so that a cumulative cost of production can be calculated. This diagram shows how beer is made, starting with the raw barley, which is heated until it germinates, then has water added and boiled, and so on. You can see that there are many different stages or processes involved. At various points in the production process, material and labour is added, and occasionally some material is lost. Some losses are inevitable and the result of a particular production process. Imagine the process of making a cup of tea. You put a quantity of cold water into a kettle and boil it, but you don't get the same quantity of boiling water out. This is because some of it will have evaporated. Similarly, in a production process, material could be damaged or there could be unavoidable waste such as scrap metal from drilling steel. Sometimes units will be removed for quality testing along the process as well. These losses are totally expected, they're unavoidable, and they're called normal losses, and we'll need to include these in the cost of the product. So we've looked at normal losses, these are expected and unavoidable. Abnormal losses are additional to the expected normal losses, perhaps caused by machine breakdown or human error. These are unexpected losses and are dealt with differently. Occasionally you'll also see abnormal gains. This is where less losses were made than expected. This could perhaps be because of new machinery or better trained staff leading to less wastage. Some losses, for example scrap metal, can be sold, and if this is the case, the proceeds of this will be included in the process accounts. As we saw in the brewery diagram, there are many different stages in a typical manufacturing process. Each of these stages will require its own process account, and for each process account there are 7 possible outcomes. There could be no losses, normal losses, abnormal losses, and abnormal gains. And for each of these it's possible that scrap could be sold or not sold. We'll look at each of these in turn in a moment. The process account looks like an ordinary T account, but with extra columns on both sides for quantity and unit cost. The left-hand side, the debit, is used to record all inputs to that process, transfers from the previous process, plus any additional inputs of material, labour, overheads, etc. The credit side on the right is used to record any outputs from that process, which will either be transferred to the next stage in the process or the finished goods account if this is the final stage in the production process. So let's look at our brewery process again. The first process account would be for what's known as the steeping stage of production. Any inputs such as the cost of barley or water or labour etc. are debited to the process account for steeping. When the steeping process is finished, the steeped barley transfers to the germination stage, and similarly the costs are transferred from the steeping process account to the germination process account, and so on. This continues throughout the production process, and every time there's a new process, the balance on the previous process account is transferred to the next one. Okay, so let's look at the most straightforward situation, a process where there are no losses, and this means that the quantity of outputs will be the same as the quantity of inputs. Here we can see that 11,000 kilograms of materials were input into the process, costing 60 pence per kilogram. In addition, there were other costs incurred for labour and overheads, meaning the total input cost for this process is £11,000. There are no losses, and so 11,000 kilograms are transferred to the next process at a cost of £11,000. This means that the cost per unit is £1. Now we'll look at a process with normal losses but no sale of scrap. The inputs are the same as before. Here though, the normal loss is recorded in the quantity column on the credit side. In this example, the normal loss is 1,000 kilograms. Nothing is shown in the units cost or the total cost columns on the credit side, as there's no value to the loss, no scrap resale. However, the fact that we've lost 1,000 kilograms means that there is only 10,000 kilograms to pass to the next process, although the total cost remains at £11,000. This has the effect of increasing the cost per unit of output from £1 per kilogram in the previous example to £1.10 per kilogram. The cost per kilogram has risen because we've fewer kilograms to transfer to the next process. Situations where the scrap is sold are dealt with in a similar way, except we'll credit the process account with the proceeds of the sale of scrap. This will have the effect of reducing the cost per unit of output to the next process. Here, scrap is sold for 50 pence per kilogram, so with 1,000 kilograms being sold, this will bring in proceeds of £500. Because 1,000 kilograms are scrapped, we only have 10,000 kilograms of good production. Remember that the debit and credit sides of each process account must balance. In this example, the inputs on the debit side cost £11,000, so the outputs on the credit side must also equal £11,000. So to make the debit and credit sides balance here, the cost of good production must be £10,500. When dealing with any proceeds from a normal loss, we would debit the bank, in this case with £500, and the credit in the first instance would go to the normal loss account. The normal loss account is then debited with the same amount, which allows the process account to be credited, as we've just seen in the example. An abnormal loss occurs when more is lost from the process than is expected under normal conditions. This could be due to human error or a machine breakdown. These abnormal losses are valued at the same unit cost as the good production. If the abnormal losses persist over a number of periods, management would need to investigate the reasons why and take any necessary corrective action. In this example, no losses can be sold. The normal losses of 1,000 kilograms are shown exactly as before. Now though, the abnormal losses are separated from the good units. In this example, 600 kilograms. So, from an original input of 11,000 kilograms, only 9,400 kilograms can be transferred forwards to the next process. These abnormal losses are valued at the same unit cost as the good production. So, in this case, £11,000 is divided by 10,000 kilograms to give a cost per kilogram of £1.10. This abnormal loss is debited to an abnormal loss account, in this case for £660. This is treated as an expense and will therefore reduce profit for that period. This also means that abnormal losses are highlighted to management, which should encourage someone to take some action. If scrap can be sold, then it may be that any abnormal losses can also be sold, in addition to the normal losses. If this is the case, the proceeds from selling the scrap are dealt with differently. The normal loss proceeds are dealt with as before, being credited to the process account. However, the proceeds from the sale of the abnormal losses are not credited to this account in the same way. Instead, they will be credited to the abnormal loss account. So, in this example, in the process account, the cost per kilogram of finished output will be calculated as £11,000, the cost of the inputs, less £500, the proceeds of the normal losses, divided by 10,000 kilograms. This works out to £1.05 per kilogram. If we look now at the normal loss account and the abnormal loss account, we can see how these two accounts have developed. The abnormal loss account is debited with £630, This is 600 kilograms multiplied by £1.05 from the credit side of the process account. However, it's also credited with the proceeds of selling the abnormal loss, which is 600 kilograms multiplied by 50p, or £300. This has the effect of reducing the amount of abnormal loss which is transferred to the profit and loss account. The normal loss account, on the other hand, is debited with the £500 from the process account and credited with the £500 from the bank. This is exactly the same treatment as before. Finally, we need to look at the treatment of abnormal gains, which occur where there is less loss than expected. This is usually the result of some kind of improvement in the production process, either in materials, labour or machinery. Here, where there's no scrap value, the normal loss is credited to the process account as normal. The cost of output is also valued as before, taking into account the normal loss. This is £11,000 divided by 10,000 kilograms, which is £1.10 per kilogram. However, in this case we actually have output of 10,200 kilograms instead of the expected output of 10,000 kilograms. Therefore, there's an abnormal gain of 200 kilograms. All 10,200 kilograms are valued at £1.10 on the credit side, and there's also a debit entry made to show the abnormal gain. 200 kilograms also valued at £1.10 per kilogram. This way the debit and credit sides will still balance, but this time at the quantity of 11,200 kilograms and total cost of £11,220. The abnormal gain in the process account will be credited to an abnormal gains account, and this will subsequently be transferred to the profit and loss account as income. Finally, abnormal gains where scrap can be sold. In this example, we were expecting to be able to sell scrap arising from normal losses, which would have brought in £500 of income. However, we also have abnormal gains, which reduce the amount of scrap which can be sold, from 1,000 kilograms to 800 kilograms. This is, of course, a good thing. Manufacturing organisations would much rather have less scrap than more, but there's a slight downside in that there's less scrap to sell. The process is exactly as before. Enter the normal loss of 1,000 kilograms and £500 proceeds. 10,200 kilograms have been produced, so this is credited to the process account and the abnormal gain of 200 kilograms is debited. The finished output is valued at £11,000 less £500 divided by 10,000 kilograms, which is £1.05, and the abnormal gain on the debit side is also valued at this figure. Now, in the abnormal gains account, we can see there are two entries: the abnormal gain of £210 from the debit side of the process account, and a debit entry for £100, which represents the 200 kilograms normal loss we expected to be able to sell but couldn't due to the abnormal gains. The credit entry for this would be to the normal loss account. Process costing can seem a little daunting at first, but hopefully this video has helped to clarify how to construct a process account, whatever the situation. Thanks for watching.